Welcome to Evangeline Ed Academy. Today, we are going to learn about Business Finance Needs and Sources, Unit 5.1 IGCSE Business Studies. Introduction. Business Finance. Access to finance is essential for any business to survive, grow, and operate daily. This section covers the main reasons why a business needs finance, the difference between short term and long term finance needs, the main sources of finance, the importance of alternative sources, the factors considered when making a financial choice, and the learning goal from this chapter is you will be able to analyze a business situation and recommend the most suitable source of finance. The need for business finance, Unit 5.1.1. Why businesses need money. Businesses need finance for three main reasons. Number one, startup capital. The initial finance required to set up the business and buy the essential long term assets. For example, buying machinery, buildings, fixtures, and fittings. Number two, capital for expansion. Money needed for growth to increase the capacity of the business or to introduce new products. For example, purchasing a new, larger factory, expanding product lines, and opening new branches. Number three, additional working capital. The day to day finance needed to cover the running cost. Current assets minus current liabilities is your working capital. For example, paying wages, settling debts with suppliers on a daily basis. What is the working capital cycle? Without enough working capital, a business cannot pay its immediate bills, even if it is profitable in the long run. This is known as illiquidity. Short term versus long term finance needs. The nature of the need determines the type of finance required. The features of the finance are number one, purpose. For short term finance, it is to cover the day to day expenses and urgent cash flow shortages like the working capital we just discussed. And for long term finance, it is to purchase high value and long term assets. Hence, it is like a startup or expansion capital which is needed. Number two, repayment time. The short term finance must be repaid within 1 year, which is usually between 3 to 12 months. But the long term finance repayment is spread over a long period, usually more than 5 years. And number three is the risk factor. For a short term finance, there is lower risk for the lender due to quick repayment. In long term finance, there is higher risk for the lender due to longer commitment and uncertainty. Examples of short term finance are overdraft and trade credit. Examples of long term finance are loans, selling shares, and leasing. The key principle is businesses should always match the source of finance to the length of the need. Using short term finance for a long term asset is dangerous. Sources of finance, internal. What are internal sources? These are money from within the business. Internal sources are preferred because they do not increase the business's debt or risk outside interference. And how do you get the internal sources? Number one, retained profit. This is the profit earned by the business that is not paid out to owners or shareholders but kept for reinvestment. So, what is the advantage of retained profit? There is no interest to pay and funds are immediately available. And the disadvantage is only available if the business is already profitable, but shareholders may want them as dividends. Number two, sale of assets. Selling unwanted or unused fixed assets, example like old machinery, land, or vehicles, can also be a profit or your internal source of finance. The advantage of sale of assets is there is no interest to pay and it converts unproductive assets into cash. What is the disadvantage of sale of assets? It may take time to find a buyer, and the business loses the use of the asset. And number three is sale of inventory, or you call it as stock, and reducing the level of inventory or stock held by the business to free up cash. What is the advantage of the sale of inventory? It reduces the storage cost and releases cash tied up in stock. What is the disadvantage of sale of inventory? It is a risk of running out of stock and losing customer sales. What are the external sources of finance, which is the short term external sources of finance, which means money from outside the business? These increase the business's liabilities, the debt, and usually involve interest or giving up ownership. What are the different sources of external finance? Number one, overdraft. Short term, usually less than 1 year, the bank allows the business to spend more money than it has in its bank account up to an agreed limit, which is called an overdraft. For example, excellent for managing temporary working capital shortages, example, paying a sudden bill. Number two, trade credit. This is again a short-term external source of finance, which is between 30 to 90 days. Here, the suppliers give the businesses goods now and allow payment later. For example, it is like how it allows the business to sell goods before having to pay the supplier, improving the cash flow. And number three is factoring. This is again a short-term external finance. It is selling the business's debts, that is, the money owed by customers, to a specialist agency, a factor, for immediate cash, usually at a discount. And this provides immediate cash flow. What are the external sources of finance which are long term? Number one, bank loan. The long-term bank loan is usually repayable between 1 to 25 years, and here a fixed sum of money is borrowed from a specific period, repaid in regular installments with interest. For example, used for large purchases like machinery or a building. And number two, issue of shares or equity finance. This is again a long-term external finance. It involves selling parts of the business called shares to investors or shareholders in return for capital. This is only available to limited companies. For example, this is used for major expansion projects and acquisitions. Three is leasing. This is again a long-term finance. It is renting assets, example, vehicles, instead of buying them outright. For example, this is used when the business needs the asset but cannot afford the large initial purchase cost. And finally, debentures. This is again long term, where loans made to the company by the public, similar to government bonds. For example, this is used to buy large public limited companies for a very long term finance. What are the alternative sources of capital? These sources are especially important for smaller businesses and startups. Number one, microfinance. It is providing small loans to people or businesses who cannot access traditional bank loans, often in developing economies. It is important as it helps alleviate poverty and promotes entrepreneurship by supporting small traders and self employed individuals. Number two, crowdfunding. This is obtaining finance by appealing to a large number of people, usually over the internet, who each contribute a small amount. And it is a low cost way to test market demand and raise capital, and often through platforms like Kickstarter or GoFundMe. Number three, grants or subsidies. These are non-repayable funds provided by the government or EU to support specific activities, example, job creation and clean energy. And this reduces the cost of capital and lowers risk for new ventures. Factors affecting the financial choice. A business must consider several key factors when choosing a source of finance. Number one, size and legal form. Small businesses have fewer options, they cannot issue shares, and large public limited companies can use debentures and equity. For example, a sole trader must rely on personal savings or bank loans. Second one, amount required. A small amount for a few days can be covered by an overdraft. A huge sum for a factory needs a loan or share issue. For example, overdraft for $1,000 loan and share issue for a $10 million loan. Length of time. Match the need to the source. For a short term need, go to a short term source. For example, buying machinery is a long term need, should not be paid for with a bank overdraft, which is a short term source. Number four, existing loans. If the business is already highly geared and has a lot of debt, banks may be reluctant to offer more loans. For example, high debt increases the risk of bankruptcy, making equity finance a safer option. Number five, financial status. A loss making business cannot use retained profits or convince banks to provide unsecured loans. Conclusion and justification. Recommending and justifying finance. When asked to recommend a source of finance, you must identify the need. Is it startup, expansion, or working capital? Number two, determine the time. Is it the need short term or long term? Recommend the source, choose one or two appropriate options, and then finally justify your choice. Explain why that source is better than others for this specific situation, referring to the factors above. Example justification. A newly established partnership needs $5,000 urgently to buy inventory for a busy seasonal period. And the need is they need additional working capital. So the time is short term for 3 months. So the recommendation that you can go for is bank overdraft and trade credit. The source here is overdraft. It is quick and flexible, ideal for covering temporary small scale cash flow shortages like seasonal stock purchases. It is repaid once the busy season ends. And number two, it's trade credit. That is buying the inventory on credit allows the partnership to generate sales revenue before the payment is due, improving immediate cash flow.